as we work with members, many of them have questions related to their credit score. At the end of the day, it ends up seeming like this 3-digit number that kind of hangs over their head and impacts various aspects of their financial lives, but they don't fully understand what their score is, how it works, and what are some actions that they can take to ultimately maintain or build a healthy credit score. So in this video, what I want to talk about is why your credit score matters, really how that credit score is determined, and then what some of those things that you can do to kind of keep your mind on building healthy credit habits and therefore having a healthy credit score over time. For background, before we get started and jumping into the topic, my name is Brian Walsh and I lead the financial planning team here at SoFi. I am a certified financial planner, but keep in mind, I don't know enough about your personal circumstances or situation for this to be financial advice. Think about this more as, high-level education or guidance. And then if you want to dive into your specific circumstances, you can always schedule a call with a financial planner and dive into those circumstances yourself. So let's get started with why a credit score matters. At the end of the day, people that I talk to, they end up knowing that their credit score exists. They know why it's important. But ultimately, a credit score can have an impact in a handful of different ways. Number one, it can impact whether or not you get access to a loan or any other types of debt, whether it be mortgage, credit cards, student loan refinance, you name it. Number two, it can ultimately impact the terms of debt that you get if you get approved. So it could impact things like the interest rate, how much they're willing to borrow you, those types of things that could either make it easier or harder for you to manage your debt picture. Number three, sometimes it can impact your ability to rent an apartment if the landlord runs a credit check. And number four, depending on your industry, it could also impact your ability to land a job. Let's say, for example, the financial services industry, which I'm a part of, would have a different perspective on credit than maybe some other industries. So there's a variety of different ways that it could impact your overall financial life and your broader personal life. When it comes to credit scores, really there are two common credit scores that we see impact people most often. Number one is FICO, and number two is Vantage Score. So the FICO score, honestly, FICO and credit score get used interchangeably a lot. It's going to be the most common credit score that's used by lenders as they're reviewing your credit profile. So we could look at this as probably being the most common and one of the ones that you may want to pay attention to understand as you're going through the borrowing process. Vantage Score, on the other hand, is a little bit newer than the FICO score, and it has some advantages related to providing broader coverage for people to have a credit score, and also providing a credit score to people earlier on in their financial lives than what may be available with the FICO score. In either case, the credit score, whether it be FICO or Vantage Score, is essentially going to provide an overall objective measure about your credit behavior in the past related to how you borrowed and repaid and managed your debt. For both of these types of credit scores, there's going to be some common components that are going to impact each one of these credit scores. Number one would be payment history. So a payment history is essentially going back and looking at, did you pay your debt obligations and quite frankly some utility obligations, depending on if they report them, on time and in full. And your payment history under different models is typically going to be the highest weighted component. So it's one of those components that can take some time to build up and recover from missed payment, but it also aligns with very responsible financial behavior in general. Typically, we look at automating as many bills as possible, so that way we don't run the risk of forgetting or making mistakes and impacting that payment history amount. The next component that is applicable to different credit scoring models would be your credit utilization. Essentially, your credit utilization is looking at your revolving debt. How much revolving debt do you have access to and how much are you currently using? So an example of this, let's say you have a credit limit of $10,000 and you have a balance of $1,000. Your credit utilization ratio would be 10%. There's a bunch of different ranges that are considered as looking at what's a good credit utilization ratio versus what's one that needs a little bit of improvement. At a high level, if you're looking at one specific number, it's generally thought of that 30%. Less than that is something that you certainly want to try to get below. But it's also something that as you get it lower, that can be advantageous from not only a credit score perspective, but also from an overall personal finance perspective, because typically revolving credit comes with higher interest rates and maintaining that debt can be pretty costly. The third component that would be common across different credit score models would really be the length of your credit history or the age of your credit history, and then the mix of your credit. So there's different types of debt that you could have. You could have installment debt or you could have revolving debt. And typically the scoring models view a healthy mix of the two as indicating that you are able to manage your overall borrowing behavior. Similarly, looking at the average age of your credit, longer tends to be viewed more favorably because it shows that you have a longer track record and exposure to managing different types of debt. The fourth component that would be common to the different credit scoring models would be credit inquiries. Now, when we talk about credit inquiries that impact your credit score, these are going to be hard credit inquiries in which your credit file is pulled. And typically, these credit inquiries end up having a relatively short-term impact on your credit score, and that impact ends up being reduced over time until it eventually goes away. So keeping in mind, it may be something where you want to keep in mind that credit inquiries do have an impact on your credit score as you're going through the process of obtaining debt in the future. Fifth, we would look at the component of derogatory marks. So this could be, a perfect example would be bankruptcies, foreclosures, things like that. And essentially these marks can follow you around and impact your credit score for longer periods of time and have an impact over time that you would, generally speaking, want to try to avoid. So now that we understand, hey, what are the different types of credit scores out there? What makes up, my credit score? Typically, we find that it's going to be helpful to start talking through some basic behavior and habits that you could put in place to, whether it be maintain your credit score, avoid, impacting your credit score negatively, and possibly, build your credit score, to a higher level over time. Depending on your credit score situation, they may have different impacts, but we look at these as kind of general responsible borrowing habits. So number one mistake to avoid would be missing or making late payments on your debt or utilities that report to the credit bureaus. Again, going back to the comment we made earlier, it could be a good idea to automate your bill pay so that way you can kind of not worry about manually making that payment and accidentally missing a payment or making a late payment because this can have a rather large impact to your overall credit score. Number two, another common mistake that we see people make would be just defaulting to closing out old accounts. That could impact the age of credit, it can impact the utilization ratio, it could impact other aspects of your credit score. Not saying you should never close out old accounts, just saying that you should think through the ramifications and then decide whether or not it's a good idea to close out your old accounts. Sometimes it's a good idea, sometimes it's not a good idea. It's about making that deliberate decision rather than just defaulting to closing out those old accounts. Another common mistake that we see people make that impacts their overall credit score would be playing the rewards game. Let's face it, credit card rewards points can be amazing to get. It kind of feels like a game where I get the rewards, I maximize them, I get the sign-up bonuses, things like that. The challenge here is it could impact different aspects of your credit score and your overall finances. Number one, if you have to spend certain amounts that you wouldn't spend in order to maximize those rewards, then that can lead to higher balances, higher interest payments, and those higher balances could impact your utilization ratio. Number two, this could impact your average age of credit, it can impact your new inquiries, and it can impact your mix of credit. So it's important to make a thoughtful decision when it comes to what credit card you're using, when you're getting new credit cards, and why are you using those credit cards, rather than solely focusing on those rewards points, because there can be a downside to rewards points. Number four, a common mistake that we see people make that impacts their overall credit and credit score would be forgetting to review their credit report on an annual basis. You can access your credit report for free on an annual basis. And honestly, sometimes there are mistakes in your credit report that could impact your score. maybe an account is double counted, maybe there's an incorrect late payment on your credit report, you name it. That's why it's always important to go in there once a year, review your credit report, and make sure that everything is going to be accurate, because you don't want to have a mistake or random information that's not true end up impacting your credit score and therefore your ability to borrow money or the interest rate that you pay. And then the fifth and final mistake that we see people make that we want to try to avoid when it comes to credit behavior would be taking on new debt while they're in the process of applying for larger loans. An example here would be, let's say you're in the process of buying a home. You're going to close on a home in a month or so. It typically would be a bad idea to, let's say, go out and buy a new car or take out a new credit card so you can buy all new furniture for your house during that underwriting process, because it could impact whether or not you get approved for that larger loan. So it's worth taking a step back, talking to the lender, and making that deliberate decision to see if that's going to be an effective use of your resources at that time. Perfect. So now hopefully you have a better understanding of why your credit score matters, the different credit scores that are out there, what makes up your credit score, and what some mistakes could be that you may want to avoid that impact your credit score. Really appreciate you joining today. Thank you so much.